Forbes Books presents Sustainable Leadership and Disruptive Growth with David Radlow. Transformation for a new and better world. Here's David.
I'm back with Marques Martin, partner at FVLCRUM, a private equity firm that creates value in the companies they invest in. Marques has provided us with invaluable insights on entrepreneurship, private equity investing, and strategy development. Now, Marques, we wrapped up part one discussing value creation, and in this episode, I'd like to delve deeper into your role. Your partners at FVLCRUM, Harrison Perry and Ben Carson, have previously discussed on this podcast the firm's investment focus and methods, but I want to hear from you about your experiences in enabling critical execution.
Well, I think it starts with the fact that that's built into how a good private equity firm should be thinking. Whereas for operating companies, that's not always how they're built to think. And this goes back to my message around we're oftentimes, because we're dealing with the lower middle market, dealing with founders of businesses. And those founders tend to be really good at the product or the service. And they forget that there's a whole bunch of other things that go into making a business really successful and giving it the ability to scale. Or it's not that they forgot, they just maybe don't feel like they had the time or the focus, or they didn't know how to prioritize it, et cetera. And so when we come in, we're saying, hey, look, you're bringing us in because, yes, you maybe want to take some chips off the table, but really you want to grow for that second bite of the apple. And in order for us to get to that larger pie, if you will, we've got to do things differently. And so we go really deep into the understanding these businesses and then leveraging things that we've learned across our careers from other companies that we've invested in, from other sources of knowledge, and we can bring those in to these companies. And then we become like a sounding board, if you will, for those companies to say, hey, look, it takes you 5 steps to do X right now. We've seen ways where you can get to X in 3 steps. Let's do that, right? And if we do that, it's going to free up time so that we can focus on these things or that things, or we're going to be able to add more money to the bottom line. But it's the job, I think, of the private equity firm to make sure that the operating company is executing on those things and thinking about those things. And if we're going to create value, right? And we also, because of our business model, we have time to go out and find some of those things where that CEO or that executive team might not have had the capacity to do such things. So we can bring in the David Radlows of the world, the Al Boves of the world, these individuals that we work with who have immense amounts of knowledge and experience, who otherwise might not ever have met these companies, right? These 10 million, 15 million, $30 million companies. We can bring them in and say, hey, look, let us leverage your knowledge, your experience to help take this company to the next level. That's something that we're good at, and that's what we should be doing.
To finish that off, could you just talk about, if you could, on pre and post acquisition integration and just assuring there's no revenue loss and the pipeline keeps going and that there isn't any disruption. And then after you figure that out, you take a look strategically at what tuck-ins may make sense?
Yeah, look, I think it's a really challenging question. Or the question itself is not challenging, but the execution of what you just asked, I think, is really tough. There is a lot of thought that goes into if we're going to do a deal, and then ultimately, once we do a deal, what are we going to prioritize right away? And so we'll typically spend 3 to 6 months prior to even closing a deal, getting to know the team, making sure that we understand the industry, developing a perspective on where growth is going to come from, understanding the gaps that that company may have so that we can know where we need to focus our attention on trying to plug those holes beforehand, doing a bunch of industry research. Like, there is a lot that goes into this idea of if we're even going to invest in a company or not, right? And that goes to this point of how do we ensure that we don't completely disrupt this business when we take over? So I need to understand, are there people who are critical to the operations of this business who are going to leave if ownership changes? Are there internal conflicts that are going on that if we don't understand them could really damage the business? Are there certain customers that are at risk of being lost and it's just a matter of time, and the owners knew that before they sold the business? That's why they're trying to sell the business. It's our job as the private equity firm to try to answer as many of those questions as possible and have a plan in place for how we're going to execute on those things. So you'll see us do, every company will have some form of a 180-day plan that's very detailed on areas of the business. What are the objectives? What are we trying to accomplish? Who's responsible for executing on those things? We will always speak with key customers, but prior to doing a deal, to kind of understand what's the strength of that relationship, what opportunities might exist for that business. And then as I alluded to earlier, we are trying to make sure that we have a very clear path to where are we going to drive growth in this business. Is it new product lines? Is it going deeper in existing product lines? Is it growing our share of wallet with our existing customer base? Do we have to go acquire new customers? Are we going into new geographies? We're going to assess all of those and see which ones make the most sense. And then going to the second part of your question, David, where you talked about the tuck-ins and how do we improve value there. Again, I think a lot of that work starts before we even close the deal. So we are already, as we're having those growth strategy discussions, talking about what are the types of companies that we would want to pursue once we close the deal. Are they competitors with the exact same product set, but maybe different customers? Are they vertically up or downstream from us, and therefore it's going to help us improve margins? How fragmented is the industry? Do we have any relationships already going into the situation? So we're doing all of that. Then we're looking at which ones of those we think could have the most synergistic value with our companies. And this is the thing that I think really kind of sets apart those firms who do tuck-in acquisitions really well versus those that do not. Because just because I acquire another company doesn't mean 1+1 is going to equal 3 or 4 or 5, right? Because these businesses have people, they have other dynamics, there are cultures that you have to think about, there are systems that you have to think about, and so we spend a lot of time thinking about how do we effectively integrate these tuck-ins into the business to make sure that we get the most value out of them. And that's another place where I would say our operating partners really play a significant role, because our operating partners tend to be from large companies that have done this over and over again. And so we try to lean on them as well to help us through this process as we're trying to create that added value from the tuck-ins and make sure that those integrations go well.
Just pivoting just a little bit and focusing on your passion for investment, in need of investment into infrastructure. Why do you see it's so important to invest in infrastructure, underserved communities, and where's our gap, and how much does America need to invest?
Well, I think the government would tell you that we need to invest trillions into the infrastructure to really get us up to speed. Look, I think it's important for a few different reasons. One, America has historically been a leader in infrastructure, when it came to creating highways and railroad tracks and all of these were innovations that didn't really exist at the same scale and level in other parts of the world. And America was looked at like on a pedestal, if you will. And I think over the last couple of decades, I don't know that you could honestly say that America's infrastructure is leading the way. And if we're going to continue to be the best country in the world, then we're going to have to invest in our infrastructure to make sure that that happens. Infrastructure allows you to connect the country and make it more efficient and pull the best ideas from all parts of our country and get them and get them together. That's why it's important, I think, for our country more broadly to make sure that we're investing in infrastructure. Then more specifically, right, some of our infrastructure is so old and so decrepit that it actually is a safety risk. And unfortunately, some of the communities that end up being impacted the most are some of these lower income communities. And that then ties to, while it's not causal per se, a lot of the lower income communities tend to be more dominated by minorities in terms of populations. And so if we haven't improved our infrastructure, if we haven't made it safer, if we haven't made it better, then there's also perhaps a greater risk to minority communities. They don't have access to food. Maybe they don't have insurances. They lose their homes. They're out on the street. Like there's a whole lot of implications to not having investment in the proper infrastructure. And then the other angle, I would say, when you think back to what we're trying to do at Fulcrum, we're trying to close the racial wealth gap. In many ways, it's more than just how do we get one or two people at the top rich because we did a good deal for them, but it's what are we doing at the employee base level too? How are we getting people out of low income situations and getting them into livable wage circumstances? Well, infrastructure can play a big role in that because a lot of the jobs that exist in building out infrastructure don't necessarily require a college education. Our crane investment is a perfect example of this. To be a crane operator, to be a crane salesman, you don't have to go to college. If you go to college, it's great. That's fine. But you don't have to. And these are jobs that will pay 60, 70, 80, $100,000 plus and are oftentimes in communities that aren't your biggest, most expensive cities. So when you're making that kind of money, you now can provide for your family comfortably. You can feed them, you can shelter them, you can take vacations, you can provide those added things. And I think that those types of jobs, those types of things are every bit as important as just going off and creating again the next couple of millionaires or billionaires kind of thing, which is also important, but again, is a smaller total people impact versus what we have the ability to do on a more broader basis.
I need to take a look at that and say, on one side, on the PE hat, you're trying to make as much money as you can for your investors and your shareholders. But on the other side, from the mission standpoint, you're trying to tackle, for example, on infrastructure. Do you feel that infrastructure, you can make enough money to get good returns so it's worthwhile going and investing into businesses and industries such as this?
Absolutely. And let's be clear, we have an impact focus, but we do not have an impact in lieu of alpha focus. So we will never make an investment where we don't believe that it can't generate a great return for our investors as well. But that has always been the mantra of the partnership of Fulcrum, is that we think that you can make money and do good all at the same time. And that may require being a bit more thoughtful about where you invest, what partnerships you're forming, et cetera. But it absolutely is a part of the equation. We're not a nonprofit. So it is our job to make sure that we're generating strong returns for our investors. Otherwise, investors won't invest with us anymore. And then we won't be able to have the impact that we're trying to have, plain and simple.
Now, you're PE focused. Have you taken a look at hedge funds, venture capital, and why do you believe that the way you're going about this to revitalize infrastructure, revitalize underserved communities is the way to go with private equity?
Absolutely. And so first and foremost, what I would say is I think along the all of the asset classes, there is a role that can be played that can have impact. And I think they're all vitally important. But with that being said, why do I believe private equity is kind of the best place to start, and why I'm invested my time there? Quite honestly, it's because when you compare us to a hedge fund, hedge funds don't have any control over the entities that they're investing in, right? Because they're investing in in public markets more often, right? And so that's kind of a pure play. Hey, we're trying to make money by investing in companies that we think are going to create value, right? On the venture side, those companies fail more than they succeed. There's no proof of concept. You're betting on the people and hoping that, look, if I spray a little bit of money across 100 different companies, a few of them are going to turn into massive wins. And I'm okay understanding that 70 or 80% of those may fail. When I look at PE, we realistically believe that 100% of our investments should have some level of success. That is the goal, right? We don't go in saying we're going to invest in 10 companies and we're fine if two of them fail, right? That would hurt us. But we're able to do that because we have some history. We have some stability. The other thing is we have control. And I think that's important too, because when you have control, you can drive the decision making that's happening. Whereas I believe in both the case of hedge funds and to some degree, to a lesser degree, but still to some degree in venture, they oftentimes don't control the decision making. And so we have, in our view, the best opportunity to drive the outcomes that we want, to have control of those, and also have the kind of history of performance, if you will, that helps de-risk some of the opportunity. And so that's why I think, for me, that's why I think private equity is the right place to start.
That makes a lot of sense. When do you decide that you're going to exit from these companies that you invest in? And before that question, really, if I wanted to take a look under the hood of your cheat sheet as to what specific things you're looking for on your have-tos and have-nots when buying, so you could give us an idea from you in terms of what you're looking for, and then specifically what can get thrown out of the bin, and then when is it time to get out?
Yeah, absolutely. So your first part of that question is probably a quicker answer. We're typically looking to exit kind of 3 to 5 years after we've made the investment. That is the incoming goal, and performance will ultimately dictate if it's 3 or if it's 5 or if it's a little bit longer than that of the situation. Now, what are we looking for? What's my cheat sheet? I think, for me, I'm looking at a few things. One, are the people that are in place, what's my opinion of them? Is it a strong leadership team that has a clue and knows what they want to do with it, and has the ability to execute? And I'm confident in that. If I can't get behind the people at the organization, then I have to ask myself, do I have access to people who I have that same confidence level that I can bring into the situation that's going to make me feel comfortable about this investment? So to me, people is one of the top things that I'm thinking about, because people drive everything. Two, I'm looking at what is the unique capability or value that this company is bringing to the table. There are a lot of crane businesses out there, for instance, but does this one have a higher level of service? Does this one have a higher level of safety? Does this one have relationships with certain customers that other companies don't have? Like, what is the special sauce? So even in an industry that could be considered a commodity industry, I'm looking for things about that business that are special, that give us a great place to start from. A third thing I'm looking at from a cheat sheet is, what do I think we can bring to the table? All right. If I don't believe that we can add any additional value to the business, then oftentimes it's probably not the right investment for us. So do we have certain customer relationships that can bring big contracts? Do we have access to certain consultants or third parties that can help this company think about how they do operations or sales or marketing or technology differently, that's going to give this company an advantage? It's looking at those types of things. And then ultimately there are just certain financial metrics that I think matter, whether that customer concentration levels, profit margins, revenue growth, those types of things. That, look, if you're a business that is cash flow negative, we're not going to do the deal. We're not a turnaround shop. If your margins are super thin, I would argue that that speaks to a lack of specialists that I mentioned first off, right? You can't tell me that you're unique and valuable, but then you've got 10% profit margins, for instance. Those two statements don't align with one another. And David, so this goes back all the way to the beginning when we were talking about why do I like finance and why do I like numbers and things like that? Because I believe that numbers can help unearth the truth around certain things. You can't take it 100% and say that's the only part of the story, but you certainly can lean on it to help bring clarity to certain statements and certain things. I would say those are kind of the key things that we're looking at under the hood, and kind of have my little cheat sheet, if you will.
Okay, appreciate that. Just taking a look at the future, what do you see the future of increasing minority wealth and improving underserved communities, and growing jobs with sustainable investments? And where do you see the industry going here?
Yeah, I'm really excited. To be honest, I think more so than any time in the history of our country, you are seeing a concerted effort to help get more representation in the world of private equity, alternative assets, and investing. And more of it, what they focus on, targeting diverse founders. And so I'm really, really excited. We're seeing more and more venture capital firms be created, which and then will lead to more opportunities for private equity deals. And as we do deals, there'll be opportunities for those companies to be bought by larger private equity firms or even go public. Right? These are all positive things, and people right now, it seems as if LPs mostly are okay with us kind of talking about it right in front of them. We don't have to use coded language, hidden meetings, or anything like that. We can come out and we can say, we want to improve the economic situations for underserved populations and minorities. And more often than not, the LP community is saying, we're with you. We want to support that too. And so I think that is reason for optimism on the chance that we're actually going to be able to have a real impact here. And when I say we, not just Fulcrum, but all the other firms that are going to come after us along the way. So I'm really, really excited about what can happen. But I'm also not naive enough to think that we're 50% of the way there. We have a long way to go. There is a lot of inherent biases in our country. There are a lot of things that people have to kind of deal with that we've historically experienced that have scarred our mindsets and it's created a certain level of feeling jaded towards certain things. So there's still a lot of work to be done, but I'm hopeful that we're moving in the right direction. And I really do fundamentally believe that human nature is to be better versus worse. And so if you continue to believe in that, then I think you can believe that we're going to solve this. We've got some of the smartest people in the world trying to tackle this problem. We can really do anything that we want to put our minds to. And I think if we all kind of continue to realize that improving minority wealth and improving underserved communities is ultimately good for the entire country, not just those subsets of the country, that will make it easier for us to have success and find success down the road.
Extraordinary, keen insight into future meaningful white space achievements yet to come in the future. What did I miss, Marques? And how do we get more information on you and Fulcrum?
The second part is easy. Obviously, you can reach out to any of the four partners. My email address is pretty easy. It's just mm@fulcrum.com, and that's Fulcrum with a V, not a U. And we're always willing to share our strategy and what we're trying to accomplish. And you can go to our website, which is www.fulcrum.com, to find more information about our firm. What did you miss? I don't know, David, I feel like you asked some very insightful questions. I hope that I was able to give answers that were good enough for you. And, I didn't embarrass you at all. I'm very humbled to be able to be on this podcast and answer these questions. So I felt like you got pretty deep, and we covered a lot of topics. So I don't know that you missed anything.
Game changing, the most humble, extraordinarily successful private equity executive in the world from Columbus, Ohio. I can't thank you enough, Marques, for coming on the podcast and sharing this information and your insightful understanding of the market and the future. Thanks again.
Thank you.
To connect with David, go to davidradlow.com. David's book set, The Principles of Cartel Disruption and Secret Stories of Leadership, Growth, and Innovation, are available wherever books are sold. This has been Sustainable Leadership and Disruptive Growth with David Radlow, a presentation of Forbes Books.